All right, welcome to the solution to a sample exam question for Chapter 18, Financial Statement Analysis. We have prepared this sample question because it is going to look a lot like what you will find on the exam. And it does look quite a bit different from the questions that you've done in the textbook. So anticipate a question that looks like this. Now, you're assessing financial statements of XYZ Corporation from the perspective of a short-term creditor. Okay, so when we talk about perspectives, if you look at the notes that Matthew prepared, I think Tom has them on his share-out drive, as does Matthew. These are the Chapter 18 notes. You will find, so first page looks like that. If you go to page 9, you will see that there's a bunch of ratios that are of particular interest to a short-term creditor. If you go to page 11, you'll see two more that talk about that are of interest to long-term creditors. Now you got to bear in mind, long-term creditors are going to be interested in the short-term ones, the sixth for the short-term plus these two here. So there would be 8 ratios of interest to a long-term creditor. And then the final perspective that we discussed was that of a common shareholder. And I think there's 6 or 7 ratios here as well that are going to be of interest to a common shareholder. So those are the different perspectives from which you could be asked to analyze a set of financial statements. Now, as part of the exam, you will get a ratio sheet. It will give you the name of the ratio and the formula for calculating it. However, it does not tell you which ratios are of particular relevance to which perspective. So you're going to have to make sure that you memorize or can figure out for yourself which ratios you need to use depending on which perspective you're asked to look at the statements from. Okay? So, based on that, we have this sample question here. So this one asks you from the perspective of a short-term creditor. You got to analyze XYZ Corporation, and we've got, so this is at December 31st, 2010. We've got a balance sheet here, a very simple one. We have some more information down below, some income statement stuff, so sales, cost of goods sold, some other, so this is a partial income statement information. We have additional information, number of shares, interest rate on the bonds, and so on. Balances from last year, or beginning of this year, I guess. So opening, accounts receivable, inventory, common shareholders, and so on. And then over here, we have ratio amounts for 2009. So last year's ratio amounts, which we will then be able to compare against the ratios that we're going to calculate to get an idea of a trend. Okay, so the requirement here. Of the 15 ratios on the formula sheet, 6 are of particular interest to a short-term creditor. Complete the table below by listing the names of the 6 ratios, calculating them for 2010, and comparing them to their 2009 values to determine whether they're getting better or worse. Okay, so what are these ratios? Well, if you look at the Chapter 18 notes, you know the first one is working capital. Next is current ratio. Acid test ratio. Accounts receivable turnover. Average collection period, which is really just another way of expressing the accounts receivable turnover. And the inventory turnover. Okay, so now let's go calculate these. So from our making reference to our formula sheet, working capital we know is current assets minus current liabilities. Current assets, cash, plus accounts receivable, plus inventory, minus current liabilities, which are just accounts payable in this case, $120,000. And so that gives us a working capital amount of $95,000. Compare that to last year's, which is right here, $112,000, and I would say it's getting a bit worse from 2009 to 2010. Okay, a bit worse. Next, current ratio. Current assets divided by current liabilities. So again, cash plus accounts receivable plus inventory divided by accounts payable in this case. And that gives us a current ratio of 1.79, which when we compare with last year,
which is up here somewhere. Current ratio 1.95. Okay, so versus 1.95, it's getting a bit worse too. So not liking the direction that this thing's going so far. Let's look at acid test, right, which is a more rigorous measure of liquidity. And maybe I'll take a little break here quickly and describe why these ratios are of particular interest to a short-term creditor. Short-term creditor is basically this company XYZ has come to you and said, hey, we want to buy some of your products. And so you have to decide, are you going to lend them money for 30 days so that they can buy your stuff and then pay you in 30 days? So do you care if they go bankrupt 3 years down the road? Not really, right? You want to make sure you get paid in 30 days. So you want to take a look at these ratios from the standpoint, or any ratios in the financial statements from the standpoint of liquidity. Do they have cash on hand now? And how good are they at converting their assets into cash? So working capital, current ratio, acid test ratio are all solvency measures. How, do they have cash available to meet their obligations? Accounts receivable turnover, average collection period, and inventory turnover are how good are they at turning their accounts receivable and their inventory into cash, right? If they turn it quickly, then you know that you can look at, okay, they got X $1,000 in inventory, you know that in a week, some of that's going to be cash and you're going to be good, right? So again, you really care about whether or not you're going to get paid. Not so much about what their stock price is doing, whether they pay nice, healthy dividends, all that kind of stuff. You don't give a damn about that. You want to get paid in 30 days. All right, so back to the acid test ratio. $40,000, right? So this is now just cash and current accounts receivable, no inventory anymore. This is a more rigorous measure of liquidity. And they work out to 0.79. And we compare that to 0.95 from last year. And now this is starting to get troubling. This is 16/100ths worse, and that's more than a bit worse. So I'm going to put worse. We'll call it more than a bit. It's not terrible, but it's a pretty significant decline. Okay, accounts receivable turnover. So that is credit sales. 750,000 divided by average accounts receivable. So we have AR of 55,000 plus last year 100,000 all over 2, and so we get accounts receivable turnover of 9.68. And if we compare that to last year, 9.75, you know what, they're about the same. Not a huge difference. And so average collection period, that's 365 divided by the accounts receivable turnover, 9.68. And that works out to 38 days. So basically, it takes them 38 days to convert an account receivable into cash on average. And last year, how did they do? 37. So again, about the same. So these two measures really measure exactly the same thing. They just express it in terms of days, the average collection period, as opposed to sort of more abstract numbers. So you know, for example, 38 days to collect. If their credit terms are net 30, then they're a little bit outside of that. They may want to kind of tighten up and crack the whip, maybe offer some discounts to their customers to pay sooner. But at the end of the day, this is still inside the realm of being not too bad, so we're not going to get too excited. Inventory turnover. How quickly do they turn their inventory into cash? And that is cost of goods sold, $450,000 divided by average inventory balance. Inventory was 120. Last year's inventory was 110 divided by 2. And that works out to 3.91. So almost 4 times a year they turn their inventory. Last year was 3.8. And so this is actually better, right? So they're turning their inventory, converting it more times in a year than they did previously. So we'll call it a bit better. Okay, so now we come to really the crux of the question. Do we give them trade credit or not? Now, let's look at, in general, how we doing. Worse, 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 the same, better. Okay. I would say, given that really all we're doing is we're looking out 30 days, we will probably be paid in 30 days. They don't look like they're going to go bankrupt in the next 3 weeks, all right? However, the trends are not good. Inventory turnover a bit better, yeah, okay, but this could be the start of kind of the final downhill slide for this company. So you might give them 15 days instead of your regular 30 days or something like that, just to kind of keep an eye on them, but you definitely want to watch them. So, you know what, you could say no and probably get full marks here. You could say, I wouldn't come out and say yes and leave it at that. I would, if you were to answer this with a kind of a yes, but sort of an explanation, that might work too, right? An unqualified yes, you might want to describe a little bit, why you would say yes, even though these ratios are all trending in the wrong direction. Particularly this acid test ratio. That one has me a little bit worried. It's going downhill fast. So, bottom line, that's the kind of question you should expect on an exam. It's going to look a lot like this, different numbers, right? But you're going to have, last year's information or income statement, last year's information, last year's ratios, and so on. And we need you to know how to calculate the ratios properly and then be able to compare them to last year and tell me, is it getting better or is it getting worse, right? So that means you need to know which ratios belong to which perspective and what the number that the ratio produces tells you. Is a small number better than a big number? And that sort of thing. All right, so good luck on the exam and have a good one.